Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Wednesday, the 12th of February, 2025, recording this about 7:20 in the morning as we speak. Okay, so we have CPI today. So let's immediately see what's priced in, what the market's looking at, and what could be some potential reactions. So first of all, just let's actually look at what's expected today. The main numbers, of course, are going to be the month-over-month number, excluding food and energy. The headline number is also important. What we're expecting here is 0.3 and 0.3 for both of the monthly numbers. It's probably going to be a good idea to actually try and see the unrounded number because, for example, 0.34 would be 0.3, whereas 0.26 would also be 0.3. So it's kind of important to see the unrounded numbers. As you can see here, the headline month-over-month number is expected to come down a little bit from last time, from 0.4 to 0.3. But the core number is the consensus is for that to actually go up unrounded, or rounded, I should say, to 0.3. And the problem here is if you actually look at that on an annualized year-over-year basis, the problem is the Fed has an inflation target, as we know, of 2% in theory. And look at this, here we are with the CPI at 3.1 and 2.9%. And if we actually have a look, I've got something here which I want to show you, is like the inflation swaps. So if we actually look at the inflation swaps and we see here, let me just bring it up, inflation swaps here. Yeah. So if you look at all of the different tenors from the 1 year out to the 2, the 5, the 10, and the 30, this is what the market is pricing. So this is not CPI or PCE. This is inflation swaps, which is where the market is trading inflation to be. And as you can see, it looks sort of stable, but once you start scrolling backwards, this is on a daily chart, and you see here that, for example, this white one here is the 1 year inflation swap. And what you can see is that if we go back, let's say 5 or 6 months, let's say into August, the forward-looking 1 year inflation swap was 1.7%. But as you can observe here, of course, this is actually going up fairly aggressively, and it's now outstripping the other tenors or durations, is now at 2.8. So it's basically gone up 1.1% in 6 months. And then if you actually really go back, let's just have a look to put this in a bit of context. You can see that it had been sort of stabilizing and had come down a lot. So we can sort of see where the problem was. The problem of the height of inflation was going all the way back to the middle of 2022. That's when the Fed really had a crisis. And then what you can see here, it went up and it peaked around 4, 5, 6%, depending on the tenor. And then it's come down. But the problem now, as you guys can see here on the right, is that it's starting to not only be sticky and not go down, but it's sort of stabilizing. And is that indeed an upward curve? Is that an upward curve? And so we continue to have a pretty strong US economy, a strong labor market. There's we have the possibility of Trump tariffs. We know that we have steel and aluminium tariffs, et cetera, et cetera. So really what the market is worrying about and starting to price in here in terms of the forward-looking inflation swaps and expectations, which you see on this chart here, is this is going up. And another way, and it could be unmoored, another way to look at this is actually just to look at the inflation swap curve. So if we look at this is just looking actually at the curve. So you see here 1 year, 2 year, 3 years. So, okay, the idea is that it's going to come down gradually over the next few years. But if we go, let's say to, I don't know, let's say a month ago, and you can see here, I'll just zoom in a little bit. But look at this. You can see here the difference. This is 1 month ago. So even just 1 month ago, the front of the curve, the 1 year swap was at, what's that, 2.6. It's now gone up to about 2.87. So you can see the direction of travel here is very much upwards in inflation concerns. Let's just put it that way. Break-evens are heading up a little bit. And we saw yesterday that Powell, in day one of his testimony, he was before the Senate Banking Committee yesterday. He said that the Fed was in no hurry to adjust interest rates, and the assumption there is no hurry to cut. And so at this point, we're at a point where if you look at what's priced in terms of the Fed funds futures, you can see here the number of cuts. We don't have a full cut priced in until the middle of September meeting on the 17th here, 1 cut. And then you sort of go, well, okay, what about two cuts? And we don't really get that being priced in by the market fully until we go out almost, a year later until September of 2026. So the point is that the market has repriced a little bit hawkishly. And really what we're trying to figure out today is, are we going to when's the first cut going to be? It looks, like there's basically zero chance in the March, in May. It looks like, a 25% chance. There's a 50-50% chance as we go out through the year. And as I say, we don't get any sort of pricing for cuts until September. So really, what Powell has basically said is like, okay, we really need to see consecutive, like a series of lower numbers on the CPI to even start thinking about cutting. And some people are saying that, if we start to get a series of hotter CPIs, we have to start even penciling in no cuts, or maybe first of all go down to one cut and then no cuts. And who knows, maybe even penciling in a mathematical probability of a hike, which I think is very, very low probability. But there we are. But it looks like the base case is for a Fed to be on hold, at least for the foreseeable future. Now, on the other side, who knows if we get geopolitical events, but more probable if we get sort of some serious reduction in the U.S. deficit, and if we get a slowdown in employment, and we get some kind of sort of fiscal drag and sort of a drag in growth. Could it be that the U.S. economy actually starts to deaccelerate and even to slow down? Who knows, maybe in the second quarter of this year. That, of course, would probably lead to some kind of deflationary pressures, which in turn would probably lead to the Fed, or at least pricing for the Fed, to certainly be cutting once and possibly even twice or even three times. But that's another 2, 3, 4, 5 months down the road. In the meantime, let me have some English breakfast tea. In the meantime, let's just actually look at what we're expecting today. So as we say, we see that, but really what the market wants to see here is something in the twos to be wonderful. Okay, so let's just look at the month-over-month number and just see what the economist consensus is here. As you can see, pretty tight. Basically, the average is for 0.29, which would be rounded up to 3, so 0.29. You can see the high is 0.4 and the low 0.2. So pretty obviously, guys, 0.2 or 0.4 would be outliers. You can see that here. The standard deviation, just for the record here, is 0.05, so 5/100ths. And that becomes interesting if you start looking at the average here is 0.29. So keep in mind 0.29 if you're here on Twitter or Live Squawk or whatever you get your news from. The standard deviation is 0.5. So if it goes to 0.1, et cetera, that will start being 2 or 3 standard deviations, which would, cause more of a market reaction. In terms of the market reaction, just thinking about it, doing some research, I think what we'll probably get, if we get something like greater than 0.4, which would be at the top end of the range, so you see something like that, that's definitely, the market will not like that in any shape or form. That would, not only would we price out Fed cut for this year, we might even start getting a mathematical probability at some, even a low probability of a Fed hike. For sure, the US dollar would spike on that on the back of probably higher yields. We get, a much higher sort of bond yields, especially at the front of the curve, actually probably all the way out the belly, but especially the 2s, 5s, 7s, and to a certain degree the 10s, but let's say the front of the curve would definitely bear flatten on that, which would cause the US dollar to go up. And I think the stock market would hate that. The stock market would not like that at all. Those higher yields, higher US dollar, and the Fed, which is definitely not cutting at all. But that's very low probability. Let's call it maybe like a 5% probability. If we get something like 0.33, 0.39, so 0.33, 0.39, again, that's maybe like, let's say a 25% probability. That I think would not be appreciated by the market. We would get, I think, a little bit of US dollar strength. The bond yields would go up again at the front of the curve, because what would happen there is that the market might price out the one cut. So at the moment, as we saw by September, we have one cut priced in for the FOMC. I think if we get something between, let's say, 0.33, 0.39, that's going to be hawkish. Fed cuts is going to be taken out. Probably the sweet spot is going to be something like 0.27 to 0.33. That might be, let's say, about a 40% chance, something like that. That's going to be good in general. That's, maybe something like the RTY, like the Russell would outperform. That's not bad. that one at all. But again, probably the Goldilocks, like the optimal, would be something a little cooler than expected. So let's say 0.21 up to 0.27. So, 0.21 to 0.27, something like that would probably be like really the perfect kind of place. Again, there's a possibility of that 25%. I think stocks would love that, especially let's say like the mid caps, even the Russell would really appreciate that lessening of inflation. At that point, in terms of Fed pricing, we might start pricing in two cuts. So not one, but two cuts, which, as you know, at the moment, we just have about one and a bit cuts. So I think that's what would happen there. And again, if we get a very cool number, so let's say less than 0.20, 0.2, again, probably very low probability, only 5% or so. That should be actually pretty bad for the US dollar. I think yields would come down. We'd probably get a bull steepener there. So the front end yields would come down a lot more than the back end yield. So that would steepen the curve bullishly. Again, negative for the US dollar. Probably pretty good for something like emerging markets. So let's say the ETF EEM. Emerging markets would like that softer US dollar. In terms of just actually how much the market would move, I mean, we can do sort of a rough prognostication for how much, let's say, the SPX would move. Something very hawkish. I think you're probably looking at a sell-off of maybe 1.5, even maybe 1.75%, even 2%. So definitely, I think we'll have a pretty serious sell-off of 150, 175 basis points. I think if we get a slightly warm number, again, my second scenario of 0.33 to 0.39, you might be looking at a sell-off, not as dramatic, maybe something like about 75 to 100 basis points. Again, a good number, let's say not an inline number, we might have a little rally plus 50 basis points or so. The perfect thing for the stock market in terms of like the ES would be, as I say, that sort of cool Goldilocks number. Let's say, a number of 0.21 to 0.27. We might get a nice rally of, let's say, 100 to 150 basis points, something like that. And if we get a very cool number, less than 0.2, who knows, we might get, again, like 125 to 150 basis points. Rally. Just in terms of some stuff I pulled up, I saw something, a Goldman Sachs note. Again, just some of their reaction functions, what they're expecting here. Again, that cool number here, SPX up 1%. Obviously, a hot number between 40 and 0.44 minus 1%. They're even saying if it's greater than 0.45, for sure, that would give a bit of a nasty sell-off. So you see the sweet spot here is something solidly in the mid 0.20s kind of thing, 0.23, 0.24, 0.25. The stock should like that. Anything we get to the top end of the 0.3s is not going to be appreciated by the market. Just in terms of pricing as well, I've just pulled up the option chain for the ES futures. Just have a look at that. So we've got our calls over here and our puts over here. So you see at the money currently trading around about 60.90. This is the ES March contract, 60.85. So you can see you're looking, this is a 0 DTE. So just for today, you're looking, the implied vol, relatively high overall, 18.4, but on these 0 DTEs, you've got implied vol here of 26. So you're looking at about something between 18 and 20, depending on which strike. So here's your delta here, 49 to 53. So let's say approximately at the money, looking about 20 points or 80 ticks. So the premium on that would be like about $1,000 or about 20 ticks. Again, on the put, similar kind of situation for at the money put, just for a 0 DTE here. You're looking to be paying just for a sort of a long put. About 20 points. So that's what the market is pricing in just before we go into the number. Okay, guys. So just in terms of other stuff going on, we have Powell again talking in Washington. It's going to be interesting. Yesterday, as I said, he sort of batted away anything about the tariffs. He said, listen, I'm going to have to wait until I get specific information. As I said at the beginning of the video, what he did say is that, they're in certainly no hurry to cut. They definitely want to see a lot of serious consecutive inflation progress on inflation. But what could be interesting today is that by the time Powell speaks in front of the House of Representatives today, it will be 10 o'clock, which of course is after CPI. So it's going to be interesting because he will have, or the congressmen and women will have the CPI data. So Who knows? Maybe there's going to be a slightly different reaction function if let's say CPI comes in very hot today. Let's just see what Powell has to say, or what he doesn't have to say. The other thing interesting, which got my attention yesterday, which I think has ramifications for oil and especially a lot of European sort of products or instruments, is the fact that Zelensky, the president of Ukraine, went on record as saying that he was prepared to start talking to Russia, to start negotiating an eventual peace settlement, and the idea being to maybe swap land held by the Ukraine, Russian land, currently captured by Ukraine, for Ukrainian land captured by Russia. Now, when that headline first came out, it said, "Oh, Zelensky willing to basically give Russia land back and stuff." So the market took that one way, but once you dug into the details, I think it is, it's a messy kind of compromise, and I think the Russians won't potentially accept that at all. We're still a long way from a peace deal, but we do know that Besant, the Treasury Secretary, is in Ukraine this weekend at the behest of Donald Trump. Trump has spoken to Putin, so definitely things are happening behind the scenes. So that could be the beginning of some kind of negotiating gambit. As you know, Ukraine currently has captured a little bit of Russian land in the Kursk region, and they're basically saying, hey, we could give that back if you swap back some of the land you captured from us. But the point here being is that I think the geopolitical risk, it's interesting just to note gold. Gold was very, very overbought, and there was a sort of what is it called? A shooting star sort of indecision candle yesterday, which we see here on the dailies here. So no surprise that gold's come off a little bit here today. We'll see what happens if that's going to be bought on the dip. But basically, a little bit of geopolitical sort of premium coming out of gold on the potential for a resolution in the Ukraine war. We also know that things potentially are going to flare up again in the Gaza Strip. But what I've been reading overnight is that Trump's threatened that all hell will break loose, along with Netanyahu, on Saturday at 12 o'clock if the hostages are not returned by Hamas. So probably there will be a deal done, I would imagine. So maybe a little bit of geopolitical tension ebbing a little bit, as I said, and some gold coming off. And look at that beautiful shooting star sort of indecision rejection candle there on gold. So maybe gold's due just have a bit of a pause. But also what's interesting and disappointing from my point of view, because it was long oil, is the oil got to an interesting technical level here. You see here that on the fib, which is the this fib going back here, failing at the 61.8 sort of level and having a bit of a red candle. Again, if there's a resolution to the Russia-Ukraine war, of course, one could presume at some point sanctions, US-based sanctions on Russian oil export would come off, thus freeing up more oil barrels for the market or more barrels for the oil market, which of course is a negative for oil. So no surprise there that, and I saw the headline, I was thinking of exiting the trade here, but the fact that there could be some resolution coming at some point. The market, the oil market, is extrapolating from that less sanctions on Russian oil and more freedom of transport for Russian oil. And so maybe oil's just going to drift back down here for a little bit. It's going to be very interesting today. If I put this, let's say, on an hourly chart, sorry, I'm just going to look at this here just to see what has to happen. Again, on this fib here, basically the bulls, if you go from this level down here, this sort of latest impulse, you could also draw it from here. But the bottom line here is that we had that headline and that sort of on the major fib here coming down. This is okay, but really the bulls at a certain point, you'd have to say at this 50% fib level, and definitely the line in the sand is definitely going to be down here. The bulls need to pick it up here in order to push it higher. If oil goes below here, I think you have to say that is failing technically. We shall see. Okay, S&P not doing much. Very low volatility at the moment. Vol is really sort of collapsing, pretty dead at the moment. I guess just waiting for more information about tariffs and, of course, the CPI today. And as you guys can see, the last couple of days, very sort of nothing, zero price action on the S&P. Similar kind of situation here on the NASDAQ. Very, very dead. So the stock's just waiting for some kind of indication about CPI and the yields in the next direction of yields. And talking about yields, if we look at, let's say, the 10-year, just grab the benchmark, which is, where is my 10-year? Sorry, guys, it seems to have disappeared. That's strange. I've got the German 10 years. Oh, I beg your pardon. Here we go. Okay, so we see here yields are creeping up. Broke this downtrend here. Was this some kind of head and shoulders? Coming back up here, sort of seller's remorse, so to speak. So the yields are definitely sort of pushing back up here. What happens now? Probably CPI is going to determine that. Let's see what happens with CPI. If we get a hot CPI, I think, this definitely could sort of push back up. But at this point, I think we're going to be range trading within, 20 to 30 basis points, because the reality is that Besant and the Treasury and Trump, they do want the 10-year yield to go down. They're trying to cut the budget, they cut the deficit, cut spending. And at the end of the day, those kind of measures will probably be a drag on growth. On the other hand, of course, so which would push yields down. On the other hand, of course, we continue to have pretty solid issuance. We might have tariffs, and of course, if CPI, if inflation doesn't sort of come down, it's going to be upward. So I think we're going to be range trading here within a 20 or 30 basis point kind of level. And if you look at the 2 years, similar kind of thing here. I think this sort of purpley pink lilac sort of box will probably be the upper range here, about 4.4, 4.41. On the other hand, I don't see any real reason for this to break to the downside. It's not as though the Fed at this point has any intention of cutting, let alone cutting aggressively. That's it. Similar kind of situation, just to finish off with the dollar here. You see that the dollar index just sort of grinding down a little bit. But again, if we get a relatively sticky CPI, that's telling us that yields are not going down too much. U.S. economy continues to go well. We have the retail sales later this week. So again, I don't know that the dollar is going to break to new highs, but again, I don't know that it's also going to break to new lows below, about 107. So I think at the moment, probably just trading in this range here is the main thing. Okay, I'll leave it there. Hope that was useful. We shall keep on talking. Have a great day. Thank you.